For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Yeah, this is Managing Your Financial Future. I just checked the card, Professor Rick Plum. It is Managing Your Financial Future. That's the correct title. All right? There you go. Professor Rick Plum. I'm Johnny Dean, your podcast host. Hi. Nice to be back here again.
Hello, hello.
Hello, Professor Rick Plum, CFP professional, certified financial planner, and both longtime guest on this program and longtime in the financial planning business. Yes. I hesitate to say you've seen it all, but I've said that in the past, and I know you can't technically have seen it all, but it seems like
we've seen a lot. And spending years on the radio with the national call-in show, accepting calls from every walk of life.
Oh yeah,
we saw a lot, and we got good at a lot.
And it's quite an education when you get people who call in or email with real life situations, and you say this is where a test of a strategy really comes through. Does it work? Does it not work?
And we've been doing the specific strategies that we've been working with for 30, 40 years. For multiple decades.
Well, even longer than
we've seen ups and downs and different things happening in those 30 years.
Oh yeah. There's a group of people right now who don't know anything except low interest rates. I mean, the younger people who are in the business, they don't understand how things might work with higher interest rates.
They've also never seen a market crash that lasted more than a couple of weeks.
Isn't that interesting?
None of these 3 years in a row like 2000 to 2002.
Yeah, which tends to, I think, change your way of thinking. Okay, and if this is where experience really counts. And I want to talk about this because the topic is really today is why your withdrawal strategy matters. As if I needed to hammer this point home even more. But I got to tell you, Professor Plum, I go online, and if I search, I did this. I went on Google and I searched retirement withdrawal strategies. Just looking to see what's out there, acting as if.
Well, then that's what a do-it-yourselfer would do.
Well,
somebody who's trying to manage their own money.
Thinking they can do it themselves.
And unfortunately, a lot of people have accumulated nice nest eggs. Now, I will tell you that accumulating a nest egg, an investment portfolio, is much easier than taking that nest egg and turning it around and creating an appropriate withdrawal strategy from it, turning it into an income source back to you.
Yeah.
Over the years, you've built it up. But you've used the market volatility, hopefully, to your advantage. Those down markets were great buying opportunities, and then the recoveries helped out. So building a portfolio, accumulating wealth is one thing. Taking that wealth and then turning it around and having it distribute cash flow to you to live off of is a completely different game. It's a harder, more difficult game.
It is. And that's not to say that building wealth is easy either, because I've seen people completely mess that up. It's easier, right? Just like flying a glider might be easier than flying a fighter jet. I don't know. They're both difficult. Forget that. My point is that
you got to know a lot about air movement.
Okay, all right. But the point is, my point is that they're both difficult. If you think the same skills that are required to build your wealth are the same as it is to distribute, they're not. So I went on and I Googled this that has to do with retirement withdrawal strategies. Found 10 or 12 different things, and they all pretty much said the same thing. I found one that said, this encapsulates pretty much what I saw, okay? They came up with, this particular site came up with 3 retirement withdrawal strategies. Okay, I could see. All right, now a withdrawal strategy is not, let's just sell stock when we need it and write a check, and that's not a strategy. Okay, I'm talking about actual strategy.
It is a strategy. It's just not a very good one.
Well, I'm not even counting that. All right, that's not, just like spending money when you make it is not a budget. Okay, it is, but it isn't.
Spending what you make, that's a lifestyle.
It really is. All right, so 3. Here's what they came up with. First one was the 4% rule. Now, let me just read this quickly. It's just a couple sentences, okay? They said, okay, here's one strategy you could try, the 4% rule. Maybe the most common of all retirement withdrawal strategies, the 4% rule calls for a person to withdraw 4% of their savings in the first year of retirement. In each year that follows, they will continue to withdraw 4%.
Okay.
Making sure to scale appropriately to account for inflation. They say while the 4% rule may seem standard in the financial industry, it's simply a guideline and not a one-size-fits-all solution. Now,
But
I
that's
agree with
also
that,
not a
but
strategy.
it isn't. Okay, so address this first, if you would, before I get to the next one.
How does that tell me how to invest my assets?
It doesn't.
It doesn't tell me anything.
It tells you nothing.
It tells me nothing about how to address my budget.
Nope.
It doesn't tell me anything about how to structure my income from Social Security and pensions. It doesn't tell me anything about planning for the future other than if I've got $500,000, I can have $20,000 a year. Well, what if I need more than $20,000 a year because I'm deferring my Social Security? What if I don't need $20,000 a year? And where am I supposed to get that $20,000 from? I mean, am I supposed to invest it all in stocks and take 20 a year out? Put it all in T-bills and take 20 a year out? How am I supposed to invest it? That doesn't tell me jack.
It tells you nothing, but if you are somebody who doesn't understand how this works and you just do a search, you might think, well, this is online. This was a big bank website. I won't say which one, but it's giving this advice, a big bank.
That's not advice.
It's not advice, but it looks like advice, all right, to somebody who says, well, let me just add up all my assets and I'll take 4% of that.
Okay.
It doesn't matter from which account. All right, we know that's not good. Okay, so that's the 4% rule. We've said many times, use this 4% as a guideline.
It's a great way to do high-level what-if planning. If I'm still kind of a little bit away from retirement, what is it going to look like? I mean,
Right.
what do I
Yeah.
need? It's not detailed at all. This is high-level stuff.
Okay, so 4% rule was one. Here was another one. Dynamic withdrawals, which I really hate. Dynamic withdrawals. It says, unlike the 4% rule, dynamic withdrawals allow you to change how much you take out of your accounts each year with an annual spending floor and ceiling to help you stay within an appropriate range. This allows you to adjust for market fluctuations, withdrawing more in years when your investment returns are higher, meaning the market's up, or less when the market's lower. Since you can take out less money if you need to, this approach can help ensure your savings last the length of your retirement. Holy cow.
Well, this first off, this is a subset of the 4% rule.
Yes, it
It's
is.
not a new strategy.
No.
If they're calling the 4% rule a strategy. And this isn't one that allows you to make changes when the market's up or down. It forces you to make changes when the market's down. So basically they're saying, we're going to set it up first year, 4%. Let's make easy math. $1 million, we're going to take $40,000 a year. Next year, unfortunately, was 2022, and the market was down 20%. And so your portfolio dropped from $1 million to 800. No, it dropped lower than that because you took 40,000 out. So now you're only at 760. So now I can only take out 4% of 760, which is about 31,500 or so. And it's a matter of, well, wait a minute. I don't want to take a cut and pay in retirement.
I have $40,000 worth of bills I need to pay.
I have expenses, and now I've got to make a decision. Do I put on the new roof? Well, that's bigger expense. Do I go see the grandkids out of state?
No.
Do I pay down the mortgage? Where do I prioritize my payments? Because I have to change them now because the stupid market worked against me. And well, wait a minute, the markets are always volatile. Sometimes they're good, sometimes they're bad. Now, on the up years where the market went up 20%, so I started with $1 million, it went up, 20, up to $1.2 million, but I took 40 out. So I got $1,160,000. Do I do anything with that extra 160, or do I just let it ride? Or should I put it off to the side?
This says nothing about that. It says nothing about
This isn't a strategy. This is a BS make you feel good thing.
You're right. See, I love how you sort of get, triggered by this, because I do too. And this all comes from the experience that we've had. It doesn't help you. And when you've done this for as long as you have, Professor Plum, you know what can happen when you do this.
Well, I mean, and I'm still left to, how do I invest the portfolio?
It says nothing. It says nothing.
How do I invest the portfolio to give myself some ability to earn some money over the years to maybe leave a legacy to the kids, but to make sure that I have a cash flow that I can count on for as long as I live?
And what am I selling when I'm taking it out? Am I selling my personal? Do I have IRAs? Okay, here again, generic advice doesn't work.
Well, I've never seen anybody call an investment strategy one where you dictate between IRA, non-IRA, and Roth and get that right. So that's a spending location discussion.
Yeah.
I think there's two levels that we're talking about here. The strategy that they're trying to portray is an investment strategy. An investment strategy is one thing. The next thing, once you've decided how much money I should have in safe money, stock portfolio, this kind of asset, once we've dictated what kind of investments we should have, and that's basically how do we create the cash flow that we need. The next question is now, okay, where do I take it from? Where do I place those assets, assuming I have IRA, personal money, Roth money?
That's another part of the discussion.
Do I have a meeting this afternoon with somebody who's got fairly large portfolio with all three different types of money, and it's a question of where do we take the different distribute? Where do we locate the treasuries, the stocks, the municipals if we're using them, this, that, and the other? Well, obviously municipals even personal money, but
well, yeah, okay, but yes, this is part of the discussion, and I'm going to have you address that here in just a little bit because I know you know what you should do. All right, so dynamic withdrawals, even worse to me.
Well, that forces you to take pay cuts at the wrong time. It puts the market in control of your spending, and the market is not going to be your friend.
No. Now, okay, so here's the third withdrawal strategy of the three that they listed.
Okay.
Bucket strategy. And I thought, okay, bucket strategy.
Well, let's see what they call a bucket strategy. They've completely screwed up the first two.
Oh, I was really interested to see what they say. All right, so here, let me read this. It's just a few sentences. The bucket strategy, they said, consists of splitting your savings into different accounts based on your expenses. Well,
okay.
All right. For example, you might keep a few months' worth of emergency savings in a savings account, along with living expenses for a year. You could keep another couple of years' worth of living expenses stored in fixed income investments.
So have they just defined one bucket or two buckets?
Don't know. Fixed income investments such as CDs, treasury notes, and muni bonds. From there, you could retain the rest of your long-term savings in your retirement or investment accounts.
So they're saying long-term savings is anything past 3 years.
Past 3 years. This is what they're saying. This strategy, they said.
So they weren't alive in 2000.
This strategy may have less risk because you'll have cash on hand and won't need to sell off stocks or tap into another account in the event of an emergency.
They weren't alive in 2007 when the market went down in 2008, early 9, and didn't recover for a little while after that.
Okay, so here's the deal. All right, now bucket strategy. This is where
the first sentence was actually pretty good.
Well, and
setting up your investments based on the appropriate time horizon.
And the last sentence, which said it may have less risk because you'll have cash on hand, won't need to sell off stocks or tap into another account in the event of emergency for short term. Okay, sort of, yes. Now, here's the problem, and this is where it really gets me, because when I talk about a bucket strategy, I'm saying these are the kinds of things this is the information that's out there. It is, here's how a bucket strategy works. 2 years of, safe money, maybe three. And then the rest you can just let it go into the stock market.
Let it ride.
Professor Plum, what's wrong with this before we get into the right way to do it?
Well, it's wrong because many times the market goes down and is down longer than 3 years.
Wasn't there a 10-year period of time where that happened?
Based on the S&P, as measured by the S&P 500, 2000 to 2009, the years inclusive there, the market was at X at the high point in the end of 2000, and into 2009 it was barely back to where it was 10 years before.
Right. So if you did this, you were in big trouble.
So yeah, if you did this, you were spending assets that were down in value from where you started or where you were. And one of the biggest detriments to a retirement portfolio is being forced to spend assets that are down in value for current spending needs. The whole idea, what I liked about the first sentence was basically time segmenting your expenses with your assets, identifying your expenses, and using an appropriate asset to backstop that expense.
It says match your assets to your liabilities.
That's
what that
the
first
key,
said.
matching your assets to your liabilities. Liabilities are my need to spend money. Spending money next year. That's a short-term liability. That is not a stock covering. That should not be a stock covering that. It should be a treasury or something that I know is going to be there, and a dollar is going to be there. If I put a dollar in, it's going to be coming a dollar out versus 90 cents, maybe $1.10, $1.20. I don't know what it's going to be a year from now. So it's all a matter of the biggest discussion on this is what is an adequate time horizon for a stock portfolio that you can rely on, with a high confidence to be equal to or greater than what you put into it.
That is one of the key differences right here. And I want to take just a moment at this point and remind people that Lucia Capital Group will tell you that whether your retirement is 15 years away, 5 years away, 25 years away, it doesn't matter. As we just said, proper planning is what you have to look out for. That's what you need. Your retirement income has a lot of risks, both before and after retirement. We've talked about these things before: compounding inflation, sequence of returns, longevity risk, market volatility. The folks at Lucia Capital Group, the professionals, they have spent many decades devising a strategy that's designed to mitigate those risks. We're talking about it right now. Our bucket strategy, that's how you know it. Each one is designed around your unique financial situation. It's designed around your goals, risk tolerance, all of that stuff. So just a reminder to let the advisors and the investment professionals at Lucia Capital Group, allow them to guide you to help get you to where you need to be in retirement. That's the goal. It's all about your future. You go to luciacap.com or give them a call at 800-644-1150, luciacap.com, or call them 800-644-1150. I want to mention that because they've been longtime sponsors of this program, and we do appreciate that. Want to let people know about that. Now, okay, going back to that so-called bucket strategy that you described, what they did was a two-bucket. It's not even a bucket. This is not a bucket strategy, all right? It is in name. It is maybe peripherally, maybe it has an idea of a bucket strategy. This has a two-bucket strategy, which gives you 3 years for a market to tank and then recover.
And it has to recover in that 3 years.
And recover in that 3 years. Okay. And then the rest is just stock. So I want to now, this is the kind of thing, if you search, what is a bucket strategy online, you're going to probably get some version of this that I just read.
Which is a bucket strategy, but it is not the correct bucket strategy.
It's not the bucket strategy.
It's not the original.
Can I just say that? The original. That's right. It's like
the original Rays,
the original or the original KFC or whatever. It's not the Colonel's recipe. I don't know. Okay, so Professor Plum, let's now talk about this.
This is new Coke. It's not the original Coke.
It's not
Coke Classic.
Okay, so you understand that this is what you're going to find online. If you look up, if you look anywhere besides where we are, if I may say that, you're going to find descriptions similar to this. And people might think, oh, well, okay, that's how you do a bucket strategy. I think I'll just go ahead and do it. Seems easy enough. Professor Plum, talk, if you would, please, about how the bucket strategy works.
Well, we have to place the appropriate investments, as I mentioned, to backstop the expenses that I have planned, whether they're necessary expenses or frivolous expenses. If they're my retirement expenses, they are my expenses, and I want to have them available to me when I want to be able to do it, not when the market tells me I can do it.
And everybody's is different.
And everybody's different. So the idea is money that I need to spend in the next X number of years. And like I said, this is where a debate comes in. How many years of safe money do I have or do I need? 3 years is too short. So what is the appropriate number? And how do we backstop it? And so we talk about a very basic 3-bucket strategy. Bucket number 1 being enough money to draw down principal and interest with safe, maybe laddered treasuries, safe assets that aren't going to be in a negative position when I draw them down over a 6-7 year period of time.
6 or 7. Now, this is an important thing. This is an important distinction. This is twice as long, and maybe a little more than twice as long as what this kind of generic description is advising.
Right. And then the second bucket is not a full stock market bucket, but it's less volatile than the market as a whole, but maybe has some volatility to try to get a better rate of return than we can get out of just straight treasuries and things of that nature. Now, for a long time, almost anything had a better return than straight treasuries. But right now, we've got some decent returns in treasuries. So in bucket number 2, we're trying to get a little bit better rate of return. And the idea is I don't need to take anything out of this bucket for this first 6-7 years while I have my original bucket number 1. But as I get close to the end of my bucket number 1, I want to take this bucket number 2 and create another, I didn't say that quite right, an additional bucket number 1 to provide for another 7 or 8 years, give or take, of safe money. The whole goal, and this is where the debate comes in. Do I go 6 and 6, 7 and 7, 7 and 8? What are my first buckets? How long do they provide for? How long do I want to provide of a time frame for bucket number 3? The bucket number 3 is the pure stock market, pure growth, reinvest everything, let it roll. We know that there has never, so far in history, been a 15-year period of time where the stock market did not outperform bonds and other things. So we want to give it maybe 15 years. We look back at 73, 74, which when we first started doing buckets, that was the worst time period we could find other than the 29 crash, but they've redone the laws since then. But in 73, 74, it took 12.8 years for an investment in the stock market to overtake an investment in T-bills.
12.8 years.
And so we looked at creating bucket 1 and 2 to be at least 12.8 years, 6 and 6.8, 6 and 7, 7 and 7.
So
and then
14,
we saw the 15-year time horizon, so we started using 15. Now, if you want to do a 6 and a 6 because you're more aggressive, you have more faith in the stock market, or you're looking at what's happening in the world and Congress, and you're saying, 6, no, I need 20 years of safe money. That's your individual bucket, and we'll develop the plan to meet your individual needs. And so, but 2 years, 3 years on bucket number 1, sometimes it'll work. Many times it'll work. And then there's times where it won't.
Well,
it'll work right up until it doesn't.
That's it. You know what? Sometimes I can go to Las Vegas and throw money on the number 6 on the craps table, and 6 comes up. Well, hey, I made the right choice, but that was gambling. And I believe that if you're doing anything less than 6, 7 years for a bucket number 1, personally, I think you're gambling.
Now, luckily today, and maybe it's because we're so conditioned with low interest rates from the past 10, 15 years, that 5% looks super attractive. But luckily today, we feel good about what we're earning in bucket number 1. And it feels comfortable. Back when CDs were earning, 0.75% a year, it was bucket number 1 was kind of difficult. And now we're getting, as I said, treasuries in that 4 or 5 range. It just feels better with bucket number 1. So we're not as worried about bucket number 1. Now, bucket number 1 may not be one investment. It probably won't be one investment.
No.
It'll be some cash for 6 months, a CD or a T-bill maturing in 6 months to replenish the cash, and then laddering them out every 6 months so that they come due at the appropriate times.
So you're kind of bucketizing the bucket is what you're doing.
Yeah, and whether you're using all treasuries, you're using treasuries and CDs, whether you're using treasuries, CDs, and then maybe a fixed annuity for a 3 to 5 year period of time because I can get a better locked-in rate of return. I'm not worried about interest rates 2-3 years from now dropping a little bit and not locking in this 4 or 5% rate that I've got. Because we're pretty sure that the rates are going to stay up where they are for a little while, but I don't think they're going to.
You can't guarantee it over the long term
forever.
No.
The market doesn't think they're going to stay there forever, but we'll see what happens. But that's why we ladder, we create the appropriate and we time horizon, and we determine the appropriate liquidity at the right time horizon and back it with the appropriate asset. You're matching your asset to that liability, back to what you said earlier. So creating your individual. Now, does it have to conform to the 4% rule? Not necessarily. It's great for high-level planning. I mentioned that earlier. And so we look at, you want to retire at 65.
You're saying the 4% rule is
it's great for high-level planning. You want to retire at 65. Your Social Security is going to be $30,000 if you turn it on at 65. And you've got $1 million in your portfolio, and you can live on $70,000 a year. And you say, well, yeah, on a high level, that looks like you're in good shape. Now let's get into the weeds and say, okay, when should you take your Social Security?
Sure.
How should you take it? When should you take it early? Should you take it late? And knowing that if I take it late, that means I have to take more out of the portfolio, and then so I'm going to be a little bit more conservative on the portfolio. Or if I take it now, I don't have to rely on the portfolio quite as heavily. And you build your strategy around all those. Now, the 4% rule is a guideline that we can use, but it doesn't mean that we have to adhere to it. For somebody who is going to defer taking their Social Security, they may be taking 7 or 8% a year out of their portfolio to start. And then when the Social Security kicks in, they're only taking 3.
Or pensions
or
maybe
4.
kick in.
The pensions kick in maybe.
That could kick in too. It just depends on your situation. You're saying all this stuff. I don't see any of this anywhere on any online strategy.
A strategy should tell you how to invest your money. None of the strategies they mentioned talk about what investment I should be using to back it up. The problem with the journalists is every investment that they talk about is basically a balanced portfolio. 50-50, because that's what a lot of the studies were done on.
Oh, because it's
starting
easy.
with the 4% rule that Dr. Benjamin did.
And it's easy. Now you mentioned 3 buckets here. there are times when you can add maybe a fourth or a fifth bucket, right?
The basic
Get
is
into
three.
that just a little
The
bit.
basic is 3 buckets.
All right.
But there are other, sub buckets, additional buckets, however you want to look at it, that some people will either require or desire. One of them has to do with lifetime income,
like a protected income,
like
sort
a
of thing.
guaranteed income source, and that has a lot to do. Not everybody should have a guaranteed income source over and above their pensions and Social Security. It all depends on how much pensions and Social Security you have once they're fully turned on.
Okay.
And what your fixed expenses are.
How is protected income different from what you've got in bucket one?
Bucket number one, we're spending principal and interest, and it's only going to last. Bucket number one, by theory, is going to be gone in X number of years. We usually use 7 to start with. It might be 6, but somewhere in there. We're using principal and interest, and it's gone. We're going to have to refill that bucket at some point.
But this protected income,
it is guaranteed by some source.
Usually
a life insurance company.
Right.
Somebody is guaranteeing, not me, I'm not guaranteeing it.
For life.
But guaranteeing for as long as you live, and if you're married, as long as you and your spouse live, if you set it up right. Yeah. And so it creates another source of income that will continue regardless of what the market does.
So you could potentially use this protected income as a supplement, in other words.
It is. And so we look at if your Social Security and you don't have a pension, but your fixed expenses are more than your Social Security, you can pick up this lifetime income so that you have enough income coming in from sources that cannot change, that are guaranteed for the lifetime. And what happens when you have all that coming in, for your fixed expenses, you're not as stressed out about the market when it moves. And unfortunately, I've met people who are 10, 15, 20 years away from retirement, and the market goes down in 2007 and 8, and they sell out of the market because they're afraid.
Yeah.
They have no need for the money. They know they don't need to touch the money for 15, 20 years, and yet they still get afraid. That's actually the best time to be investing. So we have to somehow take emotion, that fear factor, out of investing. And by having enough income coming in, each month, guaranteed to cover all of our expenses, our fixed expenses, it gives us a little bit more peace of mind, and it allows us, the average individual, to be a little bit more rational, non-emotional investor.
Yeah. Now there are people who require this. There are people who don't.
Right.
So
I've met some individuals who their pensions and Social Security are way more than they need to spend. I mean, for whatever reason, they've got a very high pension, very high Social Security. Maybe they're the triple dippers that we all hear about and things of that nature, and they don't need to buy more guaranteed income because they got more guaranteed income than they can use already.
Right.
They don't need any type of
But
this
there may
product.
be some people who do. Now, one last bucket that you may want to consider, and this certainly isn't for everybody, but there is what might be what we call an alternative bucket.
Well, alternatives are very popular in pension planning, in foundations, the big like Harvard, Yale, and all those the endowments. They all use these types. They're more sophisticated. They take a little bit different understanding. They typically have a different risk profile than the stock market. They're kind of a subset of long-term growth because they're generally illiquid. They generally do have volatility up and down, but it's not the same as the volatility in the stock market. Stock market may look like an EKG, where the volatility of an alternative may look more like a wave. It doesn't mean that the highs and lows are any different. It just means they happen at different times. But what it does is it takes away some of the overall volatility of the market because it goes up and down at different times, and it tends to have decent cash flow. That cash flow can be used to buy in on the dips and whether it be the stock market dips or the alternative dips. But it's a more sophisticated. But all the heavy duty, big time pensions, endowments, foundations use alternatives as a decent sized chunk of their portfolio because they offer added diversification,
and they give you maybe an element of growth and income potentially.
Right. And the rates of return are expected similar, if not sometimes more than the stock market, but they get there differently, and in some cases they're illiquid.
Okay, so that could another one. But when you
they're great.
Come right down to the 3 buckets, the most important difference that you get here with the type of bucket strategy, I'm going to call it the bucket strategy because I think I can. The bucket strategy that you have done, the Lucia Capital
We've been doing
Group,
it for 30 years.
They've been doing it forever, a long, long time. That's That is what I believe sets it apart.
Well, and a properly done bucket strategy tells you what types of assets to use for the right purpose, for the purpose that you're trying. Short-term money gets a short-term asset, or short-term liabilities get a short-term asset.
Yeah.
Long-term. So the first thing is you got to figure out what it is I'm spending. How am I going to do this? Now, once you've figured out I need X amount of dollars in stocks, X amount of dollars in bonds, or whatever it is, X amount of dollars, this, that, and the other, I know what my asset allocation looks like. We talked about this earlier.
That's only one part of it.
Now you figure out, how do I manage my taxes? RMDs are going to be part of this, required minimum distributions. Taxes are always an issue because we want to limit the amount of taxes. Taxes are an expense that we have to pay, and it's not a fun expense. It's not an expense we get any joy from right away. So we always try to manage that expense to a lesser amount if possible. And not just a lesser amount today, but a lesser amount over our lifetime. And in some cases, over not just my lifetime, but over my lifetime and my surviving spouse, their lifetime. Because those are kinds of things we look at. And some people will look at it even further and say, I want to manage it for my heirs as well. And that's where Roth conversions and things come in. But the idea of, should I be taking my cash flow that I'm spending today from my personal account? Should I be taking it from my traditional IRA? My Roth IRA?
Some combination?
Right.
Maybe.
If you go online and do a search on asset location, what I have seen the most is spend your personal money first, which is going to be the lowest tax treatment, which is fine, which keeps you in the lowest of low taxable income levels until required minimum distributions kick in.
They don't ever tell you that online.
Well, and then they say, don't spend your IRA until forced to by the government based on required minimum distributions.
Well, how about that tax bill I'm going to get at that point?
Right. And if I've been living in a really low tax environment for the first X number of years, and now I've been leaving my IRA grow, maybe I've done well. Maybe I've been a good investor, and it's grown a lot. And now my required minimum distribution is very large. Large enough to really screw up the taxability of my Social Security. Maybe it's large enough to throw me into an IRMA level, income-related monthly adjustment, where I'm paying more for something else that I wasn't paying for before.
All of this stuff, I got to tell you, because we're almost out of time here, but I mean, this is, you want somebody with experience handling this stuff. I said this at the beginning. You've been doing this for decades, really.
Mm-hmm. 35 years, give or take.
Right. You've seen, I can't say you've seen it all, but
I've seen a lot.
You've seen more than most, perhaps.
And between myself and many of the other advisors here that we talk all the time about different things that we've seen, we're seeing out there. We saw this for the first time, Rick.
Yeah.
We'll put a team together and say, what's going on with this? This is something we've never seen before. How do we deal with this? And let's learn about this.
And this is a strategy. No, it's the strategy. The folks at Lucia Capital Group are happy to help you out. Don't go online. I mean, don't go up and search and say, how does a bucket strategy work? Honestly, I believe if you do that based on my own research here, you're going to get the wrong answer. I mean, they'll tell you an answer. They'll tell you something that sounds like a bucket strategy. They may even tell you should match your assets to your liabilities, but that's all they're going to tell you. And it's not just in your investment. You've got to interview. This is the other thing. I wish I had time to get into this. You got to match, as you just said, your investments with your withdrawals, because you're still investing your money. You're still investing, but you're also withdrawing at the same time.
How do you do that without taking money out of something that just lost value based on what we've seen the market go through?
Well, you see, and the folks at Lucia Capital Group, they have both of those ends covered, is what we say. It's you have the investment side, you've got the planning side, and hey, one-stop shop. Is that right? Can I say? I didn't make that up. That's old. You want to talk to the folks at Lucia Capital Group, do it. I would tell you this because you need a bucket strategy. We saw it during the downturn of 2020. We saw it back in 2008. We've seen it over and over again. Give them a call, 800-644-1150, 800-644-1150. Go online, luciacap.com, LUCIACAP.com. You can get more information on this at that website. There's a website you can go to get information like this. Maybe not as in-depth as you just heard.
Well, and even at that website, you're going to get information about a lot of different topics. It's how you apply it to your specific situation that you're going to need help with. And that's where you actually need to talk to an advisor.
What a great point. This is true. An advisor can also help you be less emotional about this stuff. 800-644-1150. I said that. Go to luciacap.com. Don't forget to subscribe to this podcast. Episodes every single week. You can do so with Apple Podcasts and Spotify. Just say Managing Your Financial Future is going to get downloaded to your device every single week. Don't miss this stuff. We give you strategy. We don't just talk about generic stuff, as I've heard other people do. No, this is strategy. You're not going to hear this strategy anywhere else.
Plus, you need to hear the strategy that is specific to you.
Yes, do that. We'll tell you how it is on this podcast, but yours may be different, and probably will be a little bit different. Professor Plum, thank you so much.
You're welcome.
I appreciate this. We'll have more topics coming up. If there's any topic you would like to hear about, just let us know. Go to luciacap.com and you can send us an email right there. For Professor Rick Plum, Certified Financial Planner, CFP Professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. It's important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by full faith and credit of the U.S. government but are subject to inflation risk. Municipal bond interest may be subject to the alternative minimum tax. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Rick Plum is a registered representative with and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.